On October 29, 1929, Black Tuesday, the U.S. stock market crashed, wiping out countless fortunes. Yet on that very day, one man sat calmly in his office, counting his money. He had just made $100 million. In today's purchasing power, that's equivalent to $150 billion, wealthier than Bill Gates and Warren Buffett combined. His name was Jesse Livermore, the most legendary stock operator in Wall Street history. But here comes the cruelest twist. 11 years later, on November 28, 1940, the man who once held a fortune worth $150 billion shot himself in a hotel bathroom in New York, with only $10,000 cash left in his pocket. Why did someone who accurately predicted the 1929 crash end up like this? In 1887, 14-year-old Jesse Livermore left his Massachusetts farm and arrived in Boston alone with $5 his mother had given him. He found work at a stock brokerage, where his daily job was transcribing stock prices. This seemingly tedious task revealed Wall Street's first secret to him: hidden patterns lay behind price fluctuations. Livermore began trading in a place called a bucket shop, where people could speculate with minimal margin. He quickly discovered a special talent, predicting future market direction by observing price movements. By age 15, he had made $1,000, equivalent to an average worker's 5-year salary at the time. But what truly shocked Livermore was his realization that Wall Street's rules were simple: buy low, sell high. Only most people overcomplicated this simple truth. Livermore's career was filled with drama. He experienced 3 complete bankruptcies, rebuilding from scratch each time. The first bankruptcy came in 1901, when he was 22. He made $50,000 on Northern Pacific Railway stock but lost it all in cotton speculation. This taught him never to put all his eggs in one basket. The second was more devastating. In 1907, he accurately predicted the market crash, shorted stocks, and made $3 million. But victory clouded his judgment, and he violated his own trading principles, going bankrupt again in cotton trading in 1908. The most dramatic was the third bankruptcy. In 1915, heavily in debt and unable to borrow from any brokerage, he used his last $500 to execute a precise operation on Bethlehem Steel stock, earning back $3 million in 1 year. Livermore's story teaches us, failure isn't terrible, what's terrible is not learning from it. The market is never wrong, opinions often are. This is one of Livermore's most famous maxims. We all tend to believe our judgment is correct, a cognitive bias especially dangerous in investing. Livermore discovered that successful traders must learn to set aside ego, admit mistakes, and cut losses quickly. Modern behavioral finance confirms this. Nobel laureate Daniel Kahneman's research shows people universally suffer from confirmation bias. We seek evidence supporting our views while ignoring contradictory information. Livermore understood this a century ago. Big money is made not by thinking, but by sitting. This sounds contradictory but was his most important investment philosophy. He had a famous, pivotal point theory: markets fluctuate randomly most of the time, with only rare moments of clear trends. Successful investors should be like cheetahs, patiently waiting most of the time, striking decisively when pivotal points appear. This strategy requires extreme discipline. Livermore once spent 6 months watching a single stock for the right entry point, missing many small opportunities along the way but ultimately achieving a tenfold return at the perfect moment. Follow market leaders, not the crowd. Livermore discovered that in any bull market, certain stocks always lead the entire market upward. He called them market leaders. Successful investors should identify these leaders and concentrate investments in them. He used a vivid metaphor: if you're at the racetrack, you bet on the leading horse, not the trailing ones. The stock market is the same. This principle still applies today. Think of Apple, Amazon, Tesla. These stocks were all market leaders in their respective bull markets. Livermore's wisdom lay in understanding that the strong get stronger. Don't fall in love with your stocks. Many investors fixate on their purchase price. When prices fall, they refuse to sell because it means admitting mistakes. When prices rise, they sell too early from fear of losing profits. Livermore said, stocks don't know you bought them, and they won't rise because of your feelings. Successful investors make decisions based on market conditions, not their purchase price. Indecision kills. Many people fear making investment decisions because they worry prices might fall after buying or rise after selling. Livermore believed this hesitation is worse than making wrong decisions. The man who hesitates on Wall Street will never succeed. Know thyself. Livermore's greatest contribution wasn't his trading techniques but his deep understanding of human nature. He said, there's nothing new on Wall Street, because speculation is as old as the hills. Everything happening in the stock market today has happened before and will happen again. This reveals investing's essence. While markets change, human nature doesn't. Greed, fear, hope, and despair drive market fluctuations. Successful investing first requires investing in yourself. You must understand your character flaws and develop strategies suited to you. If you're impulsive, don't day trade. If you're conservative, choose long-term investments. Why did Livermore ultimately fail? Analyzing his life reveals several key reasons. First, he violated his own principles. After success, he began overtrading, no longer patiently waiting for pivotal points. Second, his personal life clouded his judgment. Divorce, alcoholism, and depression impaired his decision-making. Third and most crucially, he turned investing into gambling. Though he had strict principles, when emotions ran high, those principles were thrown out the window. Lessons for ordinary investors. We should learn from Livermore's tragedy, establish strict investment discipline and stick to it, maintain work-life balance, treat investing as a long-term endeavor, not a get-rich-quick scheme. Most importantly, understand that money is a tool, not life's purpose.